I'm Steve Levitt. I'm the director of the Initiative on Chicago Price Theory, and I'm glad to have you here today. We have a great conference ahead of us. Before we get started on that, we're still who's got a BlackBerry?
Yeah, I'm turning it off.
We've all got our BlackBerries. Who knows who's doing the... But so we're waiting for Nancy Zimmerman, who's in a cab on the way, delayed in the airport, but should be here momentarily. Before we get started, let me just say a few words about the purpose of this conference and Chicago Price Theory. So we're here to honor Gary Becker, one of the most influential, if not the most influential, one of the greatest economists of the last 50 years. And it's been an absolute privilege for me to be around Gary for the last 10 years. He's the reason I came to Chicago. He's the reason I've stayed at Chicago. And we've developed this initiative here at the university to try to perpetuate and to build on this incredible history we have in price theory. Milton Friedman, George Stigler, Sherwin Rosen, Gary, Kevin, many others who take a particular approach to economics, which is to value theory, to think that the simple economic theories, the economic way of looking at the world is incredibly important, but that without tying that to data and real-world questions that matter, you don't accomplish much. And it turns out to be a relatively special kind of Chicago approach in a field that more and more has bifurcated into being about doing technical theory or doing empirics that aren't particularly well motivated by the underlying theory. So we are strong believers in that approach, and we think there's no better way to convince others of the value of that approach than to bring up here a set of practitioners, very smart, intelligent practitioners, and some of our faculty to discuss the issues of the day that matter. And so the first issue we've got on tap today is about the market for talent in finance. And the way we're going to organize these panels is more or less this one we'd like to give each of the speakers 5 or 10 minutes to talk about what they think some of the biggest questions, the biggest issues are in this case in the market for talent in finance, and then open it up for discussion between people on the panel and also questions from the audience. So we'll start with Andy Rosenfield, who is the founder of LEAF. He's also senior lecturer at the University of Chicago Law School and a good friend. So, Andy?
Thanks, Steve. I'll begin briefly by saying a few words myself about Gary, even though I know it makes Gary very uncomfortable, but I can't resist. I just want to say Gary's been influential, I think, greatly to all of us. But having traveled around and introduced Gary a number of times years ago, I decided the easiest way to tell people who didn't know Gary about his role in economics was to quote Steve's father, George Stigler, who was my colleague for many years. George always said Gary was the best economist of the 20th century, but it wasn't much of a century for economics. Very, very typical of George. Let me begin with a story that I think will try to qualify what I want to talk about. There's a great story told about George Wald, who some of you may remember was a Nobel laureate in medicine, and sort of one of these hippie professors, you know the type, who kind of gives up his field and wore a tweed coat with patches and so on, and spent the 60s giving talks about the Vietnam War and the role of American foreign policy. And he did that one night in a swanky apartment in New York on Fifth Avenue, the sort of party written so well about by Tom Wolfe in the great book Mau Mauing the Flatcatchers. And at the end of the talk, I. Raby, the great physicist at Columbia, also a Nobel laureate, raised his hand to ask a question. This, I'm sure, produced glee for Wald because, as you know, in the academy there's great physics envy. And Wald was excited to call on Raby, and Raby said, let me ask, this is a talk about the Vietnam War, and Raby said, let me ask you a question. Why is it that Homo sapiens originated in Africa, say not in Australia or Canada? And Wald was terribly disappointed. He said, why would you ask me a question like that? It has nothing to do with my remarks. And Raby said, I thought you just might want to say something somewhat closer to your area of expertise. And I sort of feel the same way. I'm going to try to stay within the bounds of my area of expertise and talk a little about talent in finance, not because I think I have any talent in finance, but because in some ways I've become a professional talent scout in finance. So that I'll try to restrict my remarks. It seems to me the question about talent in finance raises at least three questions that I think are interesting. One, is there any evidence, powerful, systematic, convincing, that there is any talent in finance? Or more generally, and I think Kevin will talk a little about this, how do we separate talent from luck with so little time and so little data? And then secondly, if there is talent in finance, how would we as economists, especially trained industrial organization economists, expect talent to be compensated in a market like the market for talent in finance? And then finally, if I have time, which I doubt, I will talk a little bit about the new attack. Maybe you've read Warren Buffett's letter to shareholders this year. The new attack, this happens again and again, I think, on finance in general, as if it were an entity that created deadweight loss or waste rather than value. So to sort of get ahead of my story, let me answer those three questions. I think the answers are yes, greatly, and fundamentally misunderstood. So I would say I think there is some talent in finance, that its compensation is vast for reasons we'll see in a minute, and Buffett's very confused in this regard, that finance generates value and it's not full of waste. So to think about this, I think the question, how do you figure out if there's talent in finance, is itself very complicated, because to do that, you have to ask questions like, are there people or firms, which are just groups of people, that have a way to make excess return relative to risk? This turns out to require that you have some really operational, correct way of thinking about risk, which is much more complicated than it first seems. I don't have time to get into the details, but I think the idea of figuring out whether people really holding risk constant do better than markets is much harder than it first seems. And in my life, where I find myself today as a talent scout allocating capital to people in something that's not an asset class, say hedge funds or private equity, sometimes referred to as an alternative class or an asset class, not a class at all, it's a form of compensation. We ask questions of people about their willingness to bear at least loss, if not risk. And sometimes as a thought experiment, we ask people questions like the following sort. Suppose I know a fund manager, very talented, who's delivered, say, 700 to 800 basis points in premium over a long period of time to the risk-free asset, but with variance, say 21% variance. And just to be fully disclosive, that manager's had some rather substantial one-day or 1 month or even annual drawdowns. Perhaps 20% on a day occasionally, or 30% in a month, or maybe been down 30% over a period of a year or two. Would you like to meet that manager? My uniform experience in asking people this question is I would have no interest whatsoever. Not interested in someone who delivers 700 basis points plus or minus 21. We then say, gee, that's interesting because that's the S&P 500 since its inception, or in the last 40 years, and the way I look at your portfolio, that manager's running 70% of your assets. But people don't think about risk that way. So in part, we are thinking about how to assess or evaluate talent in light of that problem. And again, I hope Kevin will speak a little about this, but when you think about it for a minute, this has driven managers into clientele positions where they manage money and claim advantage by comparing themselves either to a reference, a benchmark, typically the S&P 500, or to a reference that is equivalent to that benchmark minus the S&P 500, so roughly the risk-free asset. And so when you think and look at talent in finance, you find it sort of offers its service clumped in that way, relative to the risk-free asset or relative to the S&P 500. Sort of odd in a way, because if someone really can produce excess return, say with the same variance as this reference, but uncorrelated, that would be a diversifying offer and would be more attractive to investors. So to, again, go quickly, because Steve asked me to make just a few opening remarks, I would say my personal view is that there is some talent relative to both of those benchmarks. It's very hard to tell statistically from luck, but I think in some ways it's a little bit like Justice Stewart. You sort of know it when you see it. And the question that I would then turn to is, how would you expect the talent to be compensated? And again, my answer here was greatly. And this because you have a vast pool of capital, say 130 trillion of global financial liquid capital, looking to invest in a very small amount of high talent managers, maybe 6% at most. And as a result, you would expect the talented to capture an enormous share of the gains from talent. You don't need any tools more than the simplest of supply and demand to reach that conclusion. I think it's exactly what we observe. But if you want to put just a little more structure on the problem, I think one of the things a number of us here will think about today are some of the people who are not here. I've already mentioned George, Gary's great colleague, but also Sherwin Rosen is much missed, and Sherwin would surely have been an important part of the center were he here today. And as many of you know, he developed an economic way of thinking about very scarce talent that can be scaled across large pools of demand. And he developed the economics of superstars, and I think that's the right structure in which to think about the way talent gets compensated in finance. So the ability to do just a little bit better across a large amount of capital explains why real talent in finance captures an immense share of the gains or value added from talent. So I think I'll stop, Steve, and let whoever speaks next.
Okay. Thank you very much, Andy. I should also mention, Eddie Lazier was supposed to be here, but he got a call from President Bush asking him to meet with him, and after a long debate, he decided he would talk to the president and only join us for dinner. So unfortunately, we're going to miss his wisdom. Next up, Kevin Murphy, professor here in the business school, member of the Price Theory Initiative, and a man who needs no introduction.
Thank you very much, Steve. I kind of first wondered why I was on this panel. I mean, I'm not in finance. I don't even pretend to know anything about finance. So I'll try to give you a little bit of how an economist or how an economist with no expertise in finance would approach this question. And I think we approach it much the way we approach most problems in economics, is think about the basics and think about the technology and the parameters that exist. And Andy pointed out a couple of the parameters that are here, one of which is volatility. That in financial markets, it takes a long time to learn what the returns are, what the risk is. You think about an asset like the S&P 500 that has a return of, let's say, 7% and a standard deviation of 21. Well, after 100 years, my standard deviation on the estimate of the mean is 2%. So it's 7 plus or minus 4. So, if you have a manager who tried to bring on a competing asset to that with 5 years of record or 10 years of record or 20 years, it's pretty hard based solely on returns to sort things out. And that's a fundamental issue. And so that's one aspect of the problem that's important. Andy touched on another aspect that was important also, which is the scalability side. That, when it comes to producing these returns, you're talking about ideas and knowledge and things that could be scaled with capital. And particularly as financial markets improve and they become deeper, the scalability may actually even increase even more. So the idea that something like Sherwin Rosen's superstars type phenomena would be there is important. And he also talked about, well, do we know how to identify talent? Well, there's really two separate questions. One is knowing whether there is a thing called talent, and the second is finding it. And from statistics, we know that it's a lot easier to figure out whether there is talent than it is to identify the individual elements, particularly if you have a large number of players, because the shape of the overall distribution and properties of the distribution help you identify the existence of talent far before it would allow you to separate out who in that distribution actually possesses that talent. Simplest example is you take like an F test with very large number of numerator degrees of freedom. We know that we can reject the null of equal means pretty easily with a large number, but nonetheless 90 plus percent at the critical value of your estimates of people's means are actually noise rather than signal. But there are other aspects that I think are important here too. And the question is why is this a market for talent as opposed to a market for products? That is, and I think that has to do with the appropriable nature of the product. That is, and this is not a market where I could go out and say, hey, here, I got this great algorithm here, let me show it to you, and, now do you want to invest with me and give me 20% of the returns? Well, you probably don't want to invest with me, but if you did, you really wouldn't need to give me 20% of the returns because you'd know the product. So it becomes a market for talent, at least partially, because of the disclosability problems and the fact that it's copyable. That's different than other markets where talent's important. Michael Jordan and people in basketball, there's a tremendous market for talent. And there it's because you can't bottle Michael Jordan. You can't watch him play and learn how to play like he does. There's some aspects of what he does that you could learn, but most of it you can't. So this market for talent, I think, develops at least partially because of that issue. And it also affects the types of contracts that are signed within the market and the structure of the market as a whole, so that the manager and becomes much more of a focus than they would be in many other product markets where knowledge can be transferred to other members of the production team. So finally, it's interesting, we're here, and one of the issues I think we'll discuss that comes up, and one of which I think there'd be wide disagreement within this room, is whether there exists talent. And I think the best prediction of economics is that that's exactly what we'd expect. That is, we expect to have an equilibrium in which there's a disagreement as to whether there is talent or not. If it was, because if everybody agreed, then it wouldn't have a return. So it seems like the equilibrium we see is exactly the equilibrium we expect. That's also true with the types of funds, like Andy was talking about, that are present. That is, the types of funds that are the most popular, the ones that can be evaluated in some way, for which there is a benchmark to which you could gauge returns. And other funds are much less popular because, in fact, it would be very difficult to judge. So I think the best prediction of economics is that the market that we see looks a lot like what we'd expect, a market in which there appears to be things that some people will say look like a good strategy or look like a good manager, but you never can quite be certain. And that lack of uncertainty and the equilibrium level of volatility for the assets we see, I think, go hand in hand. That's part of the equilibrium that has to happen in a marketplace. And it's why we see assets with particular levels of volatility as being the popular ones being traded for exactly these kinds of reasons. So I think economics does pretty well in terms of knowing why the market looks the way it does, in terms of why the focus on managers, why the types of compensation schemes that we see. We want to have managers have a big fraction of their wealth tied up again because we have a hard time evaluating them. That's a form of incentive contract. So economics has a lot to say about the market, how it looks. Unfortunately, it doesn't help us figure out how to make money, but that's what your guys' job is. So,
Great, thank you, Kevin. Our third speaker will be Dick Eldon, founder of Grosvenor Capital.
I have a few observations about the market for talent in finance, and I ought to tell you that I'm totally unhampered by facts. So I'll start with that. The major sector that I'd like to address is really the investment management subsector of the whole field of finance, because that's the one I know the most about. I would give you this overview. The compensation for most professionals in the investment management field is outrageous and far exceeds any other sector of the economy. And I think, didn't Buffett say something that in fact money managers are paid more than, there are fewer people who are paid more for doing less work in the money management field than anywhere else?
Right. He thinks it's a complete waste.
Something like that. Anyway, and most of the compensation is performance-based, and there are no barriers to entry. And what you're seeing is a massive migration that's going on. People are leaving traditional firms like mutual funds, commercial banks, investment banks, and they're joining hedge funds, private equity funds, real asset funds, and that's where the talent is shifting in a massive way. And if you look at the assets, there might be a little over $1 billion of assets in hedge funds, and maybe 20% of the talent in the world is managing those hedge funds, and 80% is managing, 80% is managing that $1 billion, and the rest is being managed by the rest of the people, but the other 20%. And that's what's happening. Today, MBAs are taking jobs with hedge funds or private equity funds, not Procter & Gamble or McKinsey or Goldman Sachs. Anyway, so there are a number of factors. Let's look at the field from the view of the employee. Aside from compensation, a major factor is culture. Certain firms like McKinsey, Goldman Sachs have a culture that's a major factor, and they have franchise value. And they also provide apprenticeships. So if a person works for Goldman Sachs, they can leave and start a $3 billion hedge fund. And it's a stepping stone. And that process is very important. And compensation is only one factor. People are undercompensated initially, and then they know they can make a lot more money. Then there's the entrepreneur, the person who leaves a job to start a fund. It used to be a person would start a hedge fund. When Nancy started her fund, she probably started with $50 million or something. Today, people are starting with $3 billion. And it used to be people figured if you ran a hedge fund for a period of years, you could accumulate $100 million of wealth. Then Jeff Vinnick came along, started a hedge fund with $800 million, and ran it for 4 years, and he and his partner left with $850 million. And people said, oh, you start a hedge fund, you can make $1 billion. And that accelerated the whole migration into the hedge fund field. Another factor is in the 90s, you had major hedge funds like Tiger, Odyssey, Steinhardt, that went out of business with zero terminal value. And in 2004, Highbridge was sold to J.P. Morgan for $1 billion. That's a sea change in the whole business. And now hedge funds see that they have an exit strategy. They can sell out for $1 billion or $2 or $3 billion. Going back to someone commented on volatility, Andy's comment about volatility, I just ought to point out long-term capital management from the day they started until June of '98 had a volatility factor of 8% and a rate of return of 28%. In the next 5 months, we were down 90%. So much for volatility. I'm sure. The other thing is that hedge funds, while they may have positive returns from the date of inception, they often have negative terms in dollar terms. And that is, in other words, a fund will be small and have a high rate of return, and then when it's larger, it has losses, and the losses exceed the gains in dollars. So while they have a positive rate of return, their return in dollars is negative. You often see that. The other problem is you see this life cycle of hedge funds. People start out small with high returns. They're entrepreneurial. They add strategies, do all kinds of things. And then they, start to buy homes and do all kinds of things and get distracted and lose their focus and their discipline. But what you're seeing is more firms that are multi-strategy or funds that are multi-strategy and firms that are multi-product. They're building businesses which they can sell. The other thing is that unlike most fields in the hedge fund business, the new people going into the field often charge higher fees than the people who've been in it for a long time. That implies a negative franchise value. And nowhere else do you see that. It also, in terms of the demand, it's incredible. I mean, people talk about 1% of assets and 20% of profits being high. Jim Simons, who ran the best hedge fund in the world, was charging 5% of assets and 44% of profits, and people were standing in line to give him money for years. And there are all kinds of talent in the finance field. There's stock pickers, arbitrageurs, asset allocators, quants, all kinds of things. And all these people are pouring into the alternative investment strategies to fill some role or other. One last point, and that is the reason for the growth in the whole field of alternative investments, hedge funds, private equity funds. There are just two reasons. One is superior risk-adjusted returns, and secondly, a low correlation with the markets. And that's it, pure and simple. And it's not just a phenomenon, it's not a fad, but those are real factors.
So just to clarify, so you think this is a good development or a bad one?
Well, I think it's a good development.
Good development, okay.
And that's the cutting edge of the investment business today.
So we have a late arrival, Nancy Zimmerman,
Sorry.
who braved the Dan Ryan construction. Nancy, I figured you're so good, you could probably comment and give a comment on what Kevin and Andy had to say. But if you prefer not to do that,
Listen,
do you want to just take a few moments and
you know,
talk about some views?
I'm happy to. You know, first of all, even hearing the last 5 minutes of Dick, I can't help but talk about anything else. You know, I'm sorry I'm a little late. It's great to be here around people who know that that an agency problem isn't when Fannie Mae cooks their books, and that there are other issues, that in fact a hedge fund is not an asset class, it's just a compensation arrangement. So I think it's a pretty logical compensation arrangement that economics would have, I think Andre tells me just to take the AP test you would need to know about, which is that incentives matter. And I think everything that Dick talked about is really relevant and important. And the reason that we are getting an industry or a compensation structure where you get superior risk-adjusted returns is because of alignment. We are getting rid of what I have seen. So I'll just give back and fill a little. I have a hedge fund, which Dick mentioned, started about 12 years ago with about $55 million. It has $3 billion now and a track record in the teens. We are as proud of our geometric numbers as our average numbers, but his point is incredibly well taken. I think that you do need to look at managers very closely and to understand what's going on. Hedge funds do present a challenge. It's a small part of the market. There's people who are all whooped up about hedge funds say there's $1 trillion in them. Bill Gross manages $560 billion. So it's a very small part of the market, but let's think about that market. That market has people who are getting incentivized to make money for their investors. So the risk that the capital takes is returned to the investors. We do see some hedge funds where that isn't the case. We see hedge funds who charge back research and development to their investors. They charge back every lunch eaten and every computer used. Obviously, the management company keeps all the research and all the good ideas. The capital that is being put at risk doesn't get those returns. So it isn't that you could just say, okay, a hedge fund is a better structure. What's better is when we have people who are managing money who are aligned with the people whose money it is they're managing. The very best is when it's their own, or a lot of their own is involved. And I think this is exactly what economics would have predicted, is that if you have people who are trying to track a benchmark or do other things, that you'll see anomalies. And we see pervasive anomalies. We've seen 12 years of anomalies, and maybe I'll even bore you guys with a couple of them because they're sort of exciting. We see people who buy bonds that are in the agency where there is a cross-defaulted bond by the same obligor with the same cash flows in the same currency sometimes, but certainly in another G7 currency, which is swappable back into the first currency, and you double your risk-free rate. So we buy a bond that's been issued by Brazil in sterling. We sell a bond that's been issued by Brazil in dollars. We take out 150 basis points per annum. This happens routinely in emerging markets. It happens in developed markets also. There's a huge market now in indexes of bonds. Indexes were a great product. Anyone who really believed there was no talent wants exactly what Kevin wants, which is we just want asset bundles. We want asset bundles with the lowest fees so we can get economies of scale and transaction costs. It makes perfect sense. So asset bundles brought us index product. Index products brought us tranching of risk. Now we time tranche risk, we default tranche risk, we do all kinds of things. The sum of the parts has to equal the whole. It often doesn't. Why not? Because every tranche has a rating. And some people care about the rating, not about the return that they get for the risk that they take. This is a standard. They are merely responding to the rules that they were given. They can get paid. They are trying to do the best they can, and they've been given goofy rules. So you wouldn't you expect goofy behavior. It's what economics tells us. But nevertheless, people make negative NPV decisions with their investors' money all of the time, and that's what hedge funds do. That's what we do. We take advantage of them. Economics would have predicted that hedge funds had to exist. Otherwise, we wouldn't have gotten any closer to market efficiency. The question is, why isn't all money being managed by people who are aligned? And I think it is a real puzzle. I'd love to hear what everybody here has to say about it because they're a lot smarter than I am. I think some of it does come from a desire to just get things that look like asset bundles with as small transaction costs as you can get, and to understand exactly what you've put in the soup, have a long-term view, and just bear the risk of the broad market. The other thing is I want to talk about a couple things Dick said, just because he's absolutely right. He talked about volatility in LTCM. I think it's a very important example, although something really did happen in the last 5 months of LTCM. 5 months before LTCM went out of business, they replaced half of their capital with a bank line. So they believed that an investor was, some guy who was getting 80% of your upside. They didn't want investors anymore. So they got rid of their investors and they took out a bank line. As soon as they had a completely different gearing ratio, they experienced different volatility. Is that a surprise? It's not a surprise. The question is, how do you have governance mechanisms and contracts that make it so that investors are thinking about exactly what's going on with leverage? Because leverage is a significant risk in this arena, and it's one that hasn't been thought about except for that it's either people think it's really good or really bad. But it figures very carefully into risk-adjusted returns, and we're not really tracking risk-adjusted returns of almost anyone. We don't have transparency into their portfolios. We don't have anything we would need to do it. And we certainly can't have done it historically. And even if we did it historically, we only know the portfolio they chose from the available universe, not what they'll choose in the future. So this is, I think, really the place that there is a conundrum and where there becomes a lot of questions about how much, what does a market tell you about how to pick a manager? And there's no question that as small amounts of money have moved from non-incentive-based managers to incentive-based managers, that before it happened, everyone thought that that hedge funds, the guys who got some of the, what we call slope, but everybody here knows take a derivative, so they probably figure out what that is, got some of the part of the return on the upside of the investors, from the investors. All of that, people thought that those guys got paid too much, that 1 in 20 was way too much. Well, as soon as price discovery began in earnest, I think we can all say that the first tick has been up, and significantly. I wouldn't agree with Dick's assessment that there is negative franchise value to existing investors. I do think that people who have existing relationships are changing prices. They're changing prices in a more sophisticated way. They're lengthening lockups. It's a price. It's changing fast. It's actually a smarter way to change prices. It aligns the investor with the manager, and it makes a better product. The biggest risk of arbitrage is that you're not there at the end. Longer lockups solve the problem and make it so the person exploiting the arbitrage will get the rents from doing it, and the investor will not be able to decide, oh, this guy doesn't know what he's doing. So I think that it's important to look at all of the prices that go into a hedge fund when we try and start talking about what's the market. So there are, first of all, there's fees that you really pay. There's things that are charged back. There's research that you might not own that's being charged to you if you're an investor. And then there's lockups.
Great. Let me just ask a couple questions myself, and then I'll open it up to the audience. Andy, you didn't really go after the Buffett question very much in the end. Do you want to talk about more about the idea of dead weight loss?
Yeah, I'll just speak very briefly. I think there's been a long history of treating speculation as wasteful. It sort of has a medieval context and persists in the mind of even very sophisticated and astute investors like Warren Buffett, who tend to characterize opportunities for compensation and intermediation as if it was a giant waste. And I think it's completely wrong-headed. I think speculation frequently makes markets work better, prevents famine, moves resources appropriately, creates real value. So I just think it's something to keep an eye on. I'm sorry Eddie did not make it to the panel, because I've been interested in hearing his perspective as someone who sort of thinks the way we do, but now is in the business of at least advising regulators in some sense. And I think there is a kind of a call for regulation, concern. Even Dick's remarks, I think, a little troubling to me. You know, the idea that there's excessive compensation in this market is unclear to me. These are all voluntary markets. People make these transactions because they think they're productive, and I think they are. And so the facts, as I said, really related to Sherwin's research, that if you can really do a little better across a large pool of capital, you can make a lot of money while, in fact, adding to social value. So I think the idea is wrong-headed. If you want to see it expressed in a sort of folksy Nebraskan way, read Buffett's letter to shareholders. And I read it as a call for further regulation of the compensation and the structure of hedge funds, which, as I've said, just as Nancy did, to me, the hedge fund industry is not an asset class. It's just a form of contracting, a form of compensation. And one would not imagine, regulation to control the wages of people who work in Hollywood or in the legal market or something, but it seems common now to read this stuff in the newspapers. So I think it's something to worry about. It's something to rebel against.
So let me just play devil's advocate for a second. If we're really talking about a zero-sum game, and you're especially saying it's not.
I think we're
zero-sum
not.
game,
Yeah, clearly not.
But a big part of it, a big component of one hedge fund making money is taking money away from somebody else. Now the obvious response is that you're providing liquidity to somebody they have some other purpose, but
right. There are a lot of instruments or pieces of the economy where the net supply is zero, but you don't lower welfare. So I think liquidity provision and risk transfer are the heart of this industry, and people pay to do it. In addition, we invest in a lot of hedge funds that I think create real resources. So further to these discussions about compensation systems, one of the funds we invest materially, and I won't mention them by name, but it's a fund that produces bond-like volatility and mid-teens returns consistently, at least over a very short period of time. So that's always the problem. We don't have enough time to observe, but we can see that, and we understand what they do. And they're not engaged in a sort of zero net supply transaction. They're really functioning as a bank. So they function in the form of a hedge fund, but they're just like a demand deposit institution. They provide liquidity, make loans, in particular in the mortgage industry, and they're an originator. They're a business. So they're a business that could have been organized as a subchapter C, a public company, and instead operates in this form very efficiently and very productively for the owners of the fund, and they create liquidity and value. So the idea that we're dealing with a zero-sum game is actually, I think, I accept your question as my answer. That's what's wrong with the issue, the idea that it's a zero-sum game when it's not.
Dick, did you want to say something?
Well, I just think you could view hedge funds as pools of talent, not pools of assets. I don't know if you would agree, Nancy.
Yeah, I think it's an accurate description of what we see right now. I do think that there are there is a movement with people using this compensation structure to start other businesses. And there's things that do look curiously like investment banks that have a very wide purview of businesses and are involved in so much of the volume of certain exchanges that I do think we have to talk about the fact that they are providing liquidity and getting paid their rents, which we call bid offer, which, I don't know if is that zero sum too, Steve?
No, I wasn't saying I thought it was zero sum, but
No.
I mean, I think it's got to be the case that a lot of what I make, if I'm on one side of like an option, I'm taking it from somebody else. Now, there's also this efficiency part too, but there's, it seems to me there is some certain kind of externality floating around that you might think could be motivating the kind of things that that Buffett was saying. But Kevin, you're the real economist. What do you think? Feel free to completely disagree with me.
No, I mean, I think we know that there's, given the amount of volatility there is and given the uncertainty there is over the returns on various assets, there's a potentially high return to searching at the private level. We know that people are going to do that search whether that's socially productive or not. And And so the fact that in equilibrium we see as much resources devoted, I think that's very predictable and something we would expect given the situation, given the parameters of the world that exist. I tend to think that, you can pick these same points in many other markets, and I think that we haven't found something better than the market mechanism for identifying better opportunities and improving the products offered to people. And I'm not sure why that wouldn't be true here. I mean, this reminds me a lot about when people used to talk about the loaf of bread in the supermarket and say, well, only 2 cents of that went to the wheat farmer. Well, that's because they thought about the bread as nothing more than, transformed wheat. But it's got a lot more inputs than that and a lot more value to the ultimate consumer because of the other components that are in it. And that's true in these financial markets as well. And one can point in most markets to potential inefficiencies, but I don't think they've been demonstrated any more clearly here than they have elsewhere, nor, even more importantly, have we come up with a good alternative. I'm not sure we got a system that looks anything better than what we have right now.
Right, you could just imagine the Ministry of Risk Transfer. It would be a very frightening idea.
Now, let me ask two more questions before we open up to the audience. One is, so the research that I've read by Burton Malkiel and others suggests that on average, the returns in hedge funds are not unusually high.
Are those pre-fees or after?
Well, it's hard to tell, right? It's complicated, but
With 2 and 20, it matters, right?
Yeah, but I think he would argue that it would be true pre-fees. Anybody have any comment on that?
I think there's a lot of evidence that there's very poor and very good hedge funds, and the mean is not a great place to be. And I think it is true that you have to be very attentive of pre- and post-fees. Steve is over there, Steve Kaplan, who's done an immense amount of work on this question in a slightly different context, the private equity and venture capital industry, where he gets very different results, if my memory's right, for seasoned or well-established repeat funds as against new funds. The results are different. I think looking at Steve's numbers, I conclude there's some significant returns pre-fee. And this is, again, related to the question, how do you expect those returns to be shared? I'm not going to characterize Eric. You can speak for yourself, Steve. But I think it is hard to invest blindly or without a lot of effort in this compensation environment, especially in light of the sort of disequilibrium we're in, where you've really induced lots of people, including kooks and frauds, to enter the industry. And one has to be careful of that.
Yeah, I also think, Dick said that what you're talking about is pools of people. I think that's right. And the returns are to the human capital, which is searching and has models and has a process. And sometimes that process also has a chemistry, places where people can say anything. If the most junior person brings up something that's relevant, it's as important as when the most senior person brings it up. These things all wind up mattering a great deal. And I think that those are the things that we're seeing in these numbers about seasoned versus unseasoned. And that is one of the reasons that I think it's very hard to make inferences about new entities, because they obviously have business risk. There's two components. There's a market risk, and then there's business risk. And I think anybody who's ever gone into a new venture of any kind will understand that the business risks associated of getting into a rhythm of process are non-trivial. Obviously, when you get senior people from certain places where they ran a whole group and then they take the whole group, they've minimized the business risk. And I do think some of the demand that we see acknowledges that. I think some of the rest of the demand that we see hasn't thought through exactly what the product they're buying is. I guess I think it's important to sort of start thinking more about how to think about what are the products, what are the prices, and what are they delivering, because you need to go back when you're building a portfolio to Kevin's point, right? That you need to figure out what products you really want, and then given the products you're interested in, where you think there's opportunities, who has a process that makes sense with a fee structure that seems to make sense, and it has the manager that's fully in line with the investor, so you get rid of agency problems.
Yeah, I would say one thing. I mean, you brought up the fact that based on studies that they don't look like they do so well risk adjusted, which is actually kind of a pessimistic thing, I think, from the point of view of these kinds of ventures, because if you think about the incentives, I mean, the incentives are to build a system that looks good against the things you're measured with, even if it's really not so good measured against some true benchmark out there. So they're going to take the kind of risks that aren't readily priced by people evaluating risk, and they're going to do things like sell asteroid insurance or whatever it is that they're doing. And so the fact that they don't look good based on conventional measures is actually, I think, a bad sign, because you would expect them, given the incentives and given the marketplace, you'd expect them to kind of optimize against the constraints that are there and tend to look better than they really would be. And you always would want to give a discount for that. So those kinds of studies, I think, are pessimistic. But this gets back to my earlier point, though. But that doesn't mean there aren't talented people out there. It just means if you reach into the barrel of monkeys and just pull out a random monkey, that he probably isn't that good. So.
All right. Oh, Dick, please.
There are two basic facts. If you look at the returns of hedge funds over a long period of time, there are two basic facts. One, that there is a tremendous dispersion of returns every year and over any 2, 3, 4, 5-year period. Secondly, there's always a subset of managers that consistently have superior absolute returns and superior risk-adjusted returns over time. Those are the basic facts that become very clear. I mean, do you agree, Nancy?
Yeah, I do agree, and I also think apropos the stuff about speculation. I mean, speculation's terrific if you can do it. It's just enormously hard. I think there's only a couple people that you see have some sort of process or culture in place where they've produced something which is, a couple decades of risk-taking in a speculative way. That have worked. And of course, those vehicles are the most limited. When you speculate, you don't need all the money in the world. You need all the money in the world to market make. That's a different, those are very different things. And they both, I think, actually do have real social value, but I don't think that the day's long enough to really get to the bottom of that.
Why don't the successful people dominate the industry?
Scalability.
So let me just
Not present.
So Gary's question was, why don't the successful people dominate the industry more? If people couldn't hear that question.
They do.
Well, I think they do. Yeah, I think they don't. I think the problem is the production function of what they do is quite limited. So that in fact, one of the problems we see is that people who are really quite excellent become much less so when they get greedy and take bigger and bigger pools of capital. So I think it's the production function of what they do limits them, which is the nature of the talent that we see. And that's why this is such a tiny amount of capital relative to the quantity of tangible capital available, I suspect.
So the margin end up not doing any better than anyone else? Would you say?
That's probably right. On the last dollar, with the amount of money thrown at people, the tendency to close is related to the fact that you get very sharply diminishing marginal returns.
Dick, did you want to say something?
I think. I mean,
So,
I think that people close. I mean, there's a lot of capacity constraint everywhere, and I think the reason people close, I think speculators close because they understand it doesn't scale because you can't get out.
Right.
I mean, however they do what they do, which I could never do, they seem to want to change their minds, and that doesn't scale. And, I think that many very good strategies have capacity limitations, and the question is, why are there still anomalies? Not, given that everyone says they're capacity constrained, and I can still point at anomalies, what are those constraints? And I think that is that disciplined people don't want to take the marginal dollar, because once that's, you've ruined your business for this, the same reason that probably Tiffany's doesn't branch out.
In fact, some of the top managers return capital every year or every several years.
Yeah, but how are we going to define the role of talent in this sector? I could see the diminishing returns as you expand out, and I think that's what you're saying. It's like a company that's more able to use the product X, but its costs rise rapidly, and so it has a limit. Now, that's the argument that's being made here. an individual, that the margin is doing about as well as everybody else, because otherwise it'd be a puzzle explaining it sometimes.
I think their strategy changes the market so that their activity itself changes their opportunity.
I also don't think we're in an equilibrium. I think
That's
that, I
probably
think the puzzle, I think it is a puzzle, and we're not in equilibrium, and we're moving fast, and there's a lot of wild stuff going on while we do price discovery.
I mean, I
And so-
think there are limits introduced by, I think, the market itself in some areas where, you know, you start pushing the market, and the bigger you are, the more of an effect you have. So that's part of it in some of these assets. The other is inherently in the compensation schedule and the amount of risk that they're taking and how much they want to take. And remember, you're not going to go to the point where the average return is, the marginal is going to be this equal to other people. So the guys returning capital, you know, think that on the margin, either because of the markets are changing or because of the incentive side, it's going to weaken their market to have a bigger structure. They get less total return with more dollars.
Yeah, no one knows. The fund that Dick referred to, Medallion, Jim Simon's fund, has been closed for, I don't know, Dick, 15 years, 10 years, makes 100% a year, returns 50% to the investors, keeps 50% roughly because he's 5 and 44. Now, Simon's has announced, we will see, a raise of a $100 billion fund. It would be interesting to see if he can raise it and what he can do with it. People don't normally think in that scale, but that's his intention.
But he also says he's going to do something slightly different, right?
Yes, I assume.
It's like,
But I assume, like always, he won't tell you what it is.
I would predict that's right.
Todd?
If the market is down and efficient, then why is it in many of these sort of sub-asset classes, take private equity, you see the vast majority of the talent operating for essentially the same cost? Very little differentiation of the compensation schemes across firms within a particular business. You would expect people, seriously, you would expect the best people to charge a lot more.
I think we should let Steve answer that question. Steve? Do? They do. There are also very exquisite signaling equilibria here. For example, it's just not cool to be an open hedge fund.
No, but
You want to say you're closed. My experience is many closed hedge funds will take money.
no, I mean, but
I
this
think-
is, you got to be careful because this isn't unique to this business. This is common all over the place. I mean, look at videotapes. Or DVDs now, they don't have videotapes anymore, but the most popular DVDs don't sell for more than the less popular DVDs. They actually tend to sell for somewhat less. And they make their return from being good by selling lots of DVDs, not by charging a higher price. So you'll go down to Best Buy and look at DVDs, and the sales of those things will differ by orders of magnitude, but the price will be almost exactly the same. So it's not at all unusual. It just has to do with, you know, the where you want to take your return. And as you're better, your demand shifts out. But if the sensitivity to that price you charge doesn't change, and it's really more demand, which is what happens in the movie business, it's not unusual at all to see the same price is charged. Now, the guys who close, then we would expect some of the closed guys to start raising their fees, but my understanding is
They
that's
do.
what you do see.
Yeah, they do.
Yeah, I also
But the
think there
open
are
guys, I don't see
polite-
why fees would vary.
I also think there are polite ways of raising your fees. I think there is a signaling mechanism.
do.
I think there is social constraints. There's a lot of stuff going on here that's really complicated, but I think there are people who have longer lockups, and I
Hurdle
think that
rates.
hurdles, lockups, and drawdowns. I mean, the way that these venture guys raise their fees enormously is that you commit to being ready to stand up for anything they find over the next 10 years. And haven't drawn down that capital, so they have an option when they find something so that they can build their own enterprise, which is their track record, without diluting their returns by taking in capital before they know they have opportunities. And so it's a very interesting synergetic way, I think, of really raising fees.
Luis?
So, it seems to be part of the answer in the returns has to be, there has to be the originating and the opportunity side, and the investment opportunity. I mean, it's all the time talking about the originating and the challenge, but something of what might happen out in the market, getting venture capital, that has to be the case. We're seeing a matching of, there are easy risks to diversify, easy opportunities to take, anybody can take them, there's little return on that. And we are seeing kind of really high investments, very complicated repayment risks or whatever, or very interesting opportunities where you can really make a big difference with a little bit of extra talent. Talent has limited time, opportunities are scarce, and the matching is what's giving us these humongous returns on the top of the hedge fund. I mean, isn't this part of what justifies the fact that, like, we don't see hedge funds taking over? I mean, it doesn't seem like it's just a compensation structure. It seems like the level management. The reason we see hedge funds just doing certain asset classes is because there are only certain asset classes on which these guys can actually employ their talent profitably and actually make a difference. I mean, if they were doing bonds, plain vanilla bonds, they were earning the same as anybody else.
I don't know. I guess my sense is that the compensation structure is spreading very broadly to a whole variety of activities. So, for example, there's a new hedge fund called Trian, run by a graduate of this business school, Peter May, with Nelson Peltz. And the structure of it is to essentially do tender offers in a hedge fund form. So instead of going through the problem of filing and doing a tender offer and so on, they're engaged in sort of activist changes of major corporations in a different compensation structure. Just a migration from one form of business organization to another so that their compensation can be more easily effectuated, but the activity is not,
It's just not the share. It's not like that the compensation is flexible. It's the fact that the level is so huge. You could have a completely variable compensation of 0.001 and 0.0020 instead of 120. So, I mean, I think the level has to be explained still.
Yeah, well,
We can agency problems and alignment matters. We still have a huge problem in getting to the level.
I do think the comp structure is more heterogeneous than you think. I think that's the point.
I think
Nancy.
that's right. Also, I mean, hurdles. I mean, once you put in a hurdle, it's 1 in 20 over a hurdle. So that's a very different thing than 1 in 20.
And a high watermark and reset. I mean, these contracts are not they're not 2 pages long.
That's right. And also, I mean, as much as there has been a hedge fund explosion, the rest of the world's growing much faster. There's also been a long-only money explosion. For every dollar that's gone into hedge funds since the hedge fund explosion, I mean, I don't know, Dick probably knows how much money has gone in traditional vehicles. Probably 10.
Right, exactly.
I mean, it's growing de minimisly as a percentage of all money being invested. And the rest of the money is being invested in ways that I'm not sure always bring the returns back to the person taking the risks.
Time for one last question.
So I suppose there is some vigorish to be had. How much of it's going to go to the manager? How
Yeah.
much to the client?
I mean, I think that's one would expect much of it to be captured by the manager. That's really the reference I make to Sherwin's work. That I think, David, your question is right, that we would not be surprised to find that the talent that exists, and just assume it's there, captures the lion's share of these benefits. It's not surprising.
I'm not sure that's true. I mean, I'm not sure we know there are other markets for talent, basketball. I mean, I'm sure the basketball players capture the wealth of the surplus. I mean, people get a lot of enjoyment from, relative to other assets, they're going to capture the value, but not necessarily relative to the consumers. So relative to the, capital assets or the desks or the computers or other inputs to the production process, it's going to go to the talent. But relative to consumers, I don't think there's any evidence from other markets where we know talent's important to say that, competition between movie stars to make movies doesn't make better movies. They do. Consumers do benefit from that. Now, what really matters is the heterogeneity in the talent and how much better the best guy is than the next best guy and how much they're able to scale that up. And so the key thing that's going to determine the distribution, go back to Sherwin's stuff, is this question about how scalable these things are going to be. And the more scalable they get and the more heterogeneous the asset, the talent is, that's where they're going to get their returns. But consumers will get a lot of the value too, I think, ultimately, and I think they already are. Well, no, then there's competition at yet another level. So, yes, absolutely. Just like an intermediate good in any other industry.
Great, well, I think we should end this session here, take just a few minutes to clear our head, and then we'll come back and talk about the environment. Thank you very much for the panel. It's been a stimulating discussion.
Sorry for being late.